right, finally. Boy, YouTube has been glitchy. Holy smokes, the last week or so. But welcome to Trade Non-Farm Payrolls Live. Good to see ya. Guess I'll kill the music, as beautiful as it was. So, guten Morgen. My name is Wayne McDonald. I will be your host today on this thing called Trade Non-Farm Payrolls Live here at Forex.Today. Collaboration between Traders Way and Traders Analytics. Let's go. Let me remind you that trading Forex is risky. It's not appropriate for everybody. Your past performance, good or bad, is not necessarily indicative of future results. You might have been a hero yesterday, you could be a zero today, and vice versa. This is why this is not a game for degenerate gamblers. Hey, if you go to Vegas as a degenerate gambler, at least you have 50-50 odds. Here it's up, down, or sideways, right? So you're better off being in Vegas if you're a sloth. Or as Michael Jackson would say, you're just ignorant. You're just ignorant. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Hey, everybody. Good morning, Pip Pirates. Arr, yeah. Look at that. Yeah, look at that. Noise! Somebody said the other day they missed my other two screens. There you go. I just didn't need them. Also, this is my home office. I have an office, and so I have other needs. Also, I tend to trade now a lot, if not mostly, on my laptop, which is a big change because I used to need, at one point I had 18 screens back in the day. But with Traders, I can do all my analytics really, really quickly and develop my trade plans just on one screen. I don't need 18 screens to figure out I want to do Euro Kiwi or something. I can just do that now. Then I can go to my chart. So I can do what I used to do. Let's get the light on here. Oh. I can do what I used to do on 18 screens. I can do it on, no, that's not good. I can do it on one screen now, and I can do it 10 times faster. It's called progress. How do you remember your factors of production? Capital and labor? Well, we found a way to mix them together to get a higher output. We call that entrepreneurialism and technology. Yeah. Cool. So, did you answer the poll? Did you answer the poll? What will NFP be today? Higher or lower or perfectly exactly the same as expected? And then the next question I guess I could ask is, who's the heck is they? Who decided 110 versus 111 versus 112? Who is your they? I want you to be your they. So we could even analyze whether what they expect, maybe they are stupid. You are the boss because you have the data. Remember, Oh, oh, whoa, weird. YouTube, you have really outdone yourself. Outdone yourself by 1,000%. That is the weirdest bug I've ever seen since broadcasting on YouTube for what, 20 years? Oh my God. It was broadcasting twice. And what I was being told and shown was perfect. It said I had excellent connection and everything was great. It told me there were dozens of people logged in. And then there were some other weird glitches, but at least we were broadcasting. And then I switch over and notice that something else is broadcasting. Holy smokes. There were dual broadcasts, and the one that I was being shown by YouTube was fake. And the one on YouTube, I didn't even know, like, where the heck is that coming from? Whoa. So, anyway, sorry about that, but this is topsy turvy. So, it's not that I'm back. I've been broadcasting, and so now I am told that you can actually see tradars now. I've done the disclaimer and everything. Yeah, okay, you can see it. So I guess I have to manually do the disclaimer. Let me remind you that trading is risky, not appropriate for everyone. Past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Wow. Okay, well, look, Tradars is free. You know this. Most of you are subscribers. It's totally free. YouTube inherently has a lag, and the lag gets worse and worse over time. So if you want the analysis super, super, super duper real time, um, tradars.com, register. Again, it's free. It takes 5 seconds, really. You don't get put onto some sales funnel. I'm not going to pitch you. If you don't want to buy it, don't buy it. I'm not going to convince you. What the heck? You're an adult. But almost everything you're going to see today is free, anyways, including right now. The live stream is free and without lag. So why don't you just join us over there? So I'll give you the link. Oops, that's capitalized. So there's our zero lag live stream. So we have, our internal room is broadcasting on the YouTube channel. So J and D and me, we're on the inside, and we don't have a lag. So good morning. Cool. So, anyways, holy smokes, that was strange. That is just so, two streams running on one stream key. And YouTube lying to me that you were seeing what I saw. Meanwhile, you saw nothing but an empty room. Super strange. So, anyways, we got the disclaimer in there. We got not farm payrolls coming up. Just so you know, Forex.Today is a collaboration between Traders Way and Tradars. Traders Way is your analytics. No, it's not. Yeah, Tradars is your analytics. Traders Way is your execution. It's a match made in heaven. Most of Traders is free. That is true, but there are premium upgrades, and the most money you could possibly spend is $200 a month, right? $199. You're like, oh my God, I love everything, but $200. I want to become a billionaire Forex trader, but I don't have $200 a month for infrastructure. Okay. But we do have a solution to that. We also now have a rewards program. Okay, and let me show you. let's do some. Let's do something fun here. Let's say you make 3 trades a day by one mini lot. Instead of $200 a month, okay, you'll pay $149. See, you just have to execute through our execution partners, aka Traders Way. Okay, shouldn't have clicked the wrong button. Check this out though. You do 3 trades a day, mini lots, and you do 2 mini lots a day. 85%. Instead of paying $199 a month, you're paying $29 a month because Traders Way is paying for you. It's not that I'm generous. I'm not. It's that you have value, and Traders Way is sharing. Yeah. So there you go. Pretty cool, right? And that's for U.S. clients can't open accounts at Traders Way. We all know that, but we do have an execution partner for that. If you're international, it's easy peasy. All of it takes 2 minutes. My God, cool. So there you go. It's a great collaboration. I found somebody to pay for your analytical. Well, not it's more than analytics, isn't it? If you have me working with you every single day, um, oh my God, right? But let's move on.com. We got a lot to do today. I already went through all this, but you weren't there. I was all by myself. Good morning. Let us get you up to speed on the current global macro environment. Today's market sentiment is currently neutral and indecisive, as reflected by a flat daily risk score, showing a clear divergence from the broader risk-on trend seen over the past week. This pause in momentum is largely driven by a slight decline in the U.S. 10-year Treasury yield to 4.372%, and a cautious posture in the Forex markets as traders await high-impact U.S. labor data. 1. The Swiss CPI was released at 0.5%, which was exactly what economists expected. In the UK, pharma stocks are helping the FTSE 100 move higher this morning. Everyone is currently focused on the U.S. non-farm payrolls report coming later today, as it will determine if the recent labor market strength is still intact. Meanwhile, the British pound is gaining ground against the U.S. dollar as traders look ahead to tomorrow's UK inflation data. Biggest movers right now, high-yield bonds and Nikkei 225 are down. Corn, soybeans, and Bitcoin are up. Cool, man. Excuse me. Things that I noticed. Dollar's still strong. So that's that. Dollar's still strong. It's not any stronger, but it's strong. That's a high number. Oil way down, 67 and falling. Nice. So there goes our inflation scares, which of course we knew was coming. But some of the world's still freaking out. Freaking out like the Fed's got to raise, the Fed's got to raise. Why? So dumb. Anyways, gold stable above 4K. It's been about this price for a while. Bitcoin stable above 60. Okay, fine. S&P 500 still at 7,500. All right. Okay. So not a lot going on there. Volatility has dropped well below 17, which is great. Now, eventually this should be 12. And not because of risk on, but because of low volume and volatility. Yeah. So this is a totally normal thing. Looks like risk is slightly on overall, but, and yes, that's a big but. I love big but jokes and I cannot lie. I believe Kospi took a nosedive. Yeah, I think Kospi took a nosedive today, and that could be very bad news for Nazi. Okay, so what's going on in the world today?
Euro, yen price forecast. Euro holds above 183.75 with bearish pressure mounting.
India oil minister calls for increased fuel storage capacity.
Japanese yen, intervention, uncertainty reshapes carry trades. BN, wing. Oil prices edge down amid hopes for US-Iran talks progress.
Non-farm payrolls set to grow by over 100K in June, endorsing bets of Fed rate hikes.
United States dollar index slumps to near 101 in countdown to the US NFP data. Yen rises amid intervention risks.
New Zealand dollar strengthens against US dollar on weak US data ahead. NFP. Investing live European markets wrap. Yen sees sudden jump. Dollar.
So somebody at FX Street for weeks and weeks and weeks, like every single day, is writing reports about how the Fed is going to raise interest rates. And every piece of news points to their opinion, which is actually quite a dangerous game and is not good for traders, but shouldn't also, if you're truly an economist covering, um, working for the media, it's also, I don't know, dangerous reporting. But whoever's writing these reports, because when you click on it and you pull up the article, it just says staff. They don't know what they're talking about, and it's really dangerous when this stuff gets reported. So where did I see that? Yeah, on non-farm payrolls set to grow by over 100K. All right. Endorsing bets of a Fed hike. Why? Why does that make any sense? What's the mandate of the Fed? Full employment. So they're going to say, oh my God, too many people are getting jobs, raise interest rates. Now you're like, well, that would point to high inflation. And that, well, okay, so then you wouldn't talk about non-farm payrolls growing over 100,000. You would talk about wages. And wages would have to spike very dramatically for that to even be on the radar. I mean, they watch it, they know, but to say wage growth is up 0.1, so that means the Fed has to raise interest rates. No, that doesn't make any sense. So they would raise interest rates if GDP was ridiculously high. They would raise interest rates if inflation was ridiculously high. But we just had the biggest contributor to inflation just drop by 43%. Like, wouldn't you talk about that if you're a reporter writing about monetary policy? You're like, well, we had a 50-50 chance of one hike in December, maybe, based on old oil prices. But now that oil prices drop 40%, that'll probably be priced out. So let's look at the yield curve. And then you go to the yield curve, and now you have but this is negligence almost. Sorry, FX Street. Look, we've been friends a long time, but this writer has been writing this for weeks, and it doesn't make any sense. It's like you hired someone that is not an economist, doesn't understand monetary policy, but they're also not a trader. So they're writing gobbledygoo. So FX Street, if any of this is true, hire somebody that's qualified. But here's the good lesson for all of us. You don't need this. You don't need other people's opinion. Yeah, Greg has been pounding the table with that. And I 100% agree with you, Greg. But here's the thing. Now we know. We should know better. We are the experts. We should be able to look at that and say, well, we have the data, so we have to choose, right? Red pill or blue pill. The truth is to do the work yourself and look at things like the treasury yield curve, and we have this for every central bank in the world, and then be able to interpret that into what do institutional investors believe monetary policy in the future will be. And this is now very, very smart, very, very educated um, economists, quantitative analysts, traders and investors that are putting billions on the line versus a reporter that makes $22,000 a year, takes the bus to work, not a Bentley, right? So you got the truth, you can do it yourself, take some time, but we even have AI that will then interpret it for you and tell you in plain English. We call that a large language model. We're a neural network, but whatever, it'll spit it out to you. Good. So now you just don't need any of this. This is just to keep you aware of headlines as they're coming out. But you should chuckle almost every morning and say, well, I disagree with that, but whatever. It is what it is. So that's what makes you Illuminati, that you're aware of the news and whether you agree or not agree. That is so much better. What's up, Bernard? What's up? So yeah, Greg and I agree. Greg's been around. He knows. Okay, what reaction will happen to gold during the NFP news? Okay, well, a couple of things. What will the news results be? So our projection is what, 110, 111? Okay, fine. Whatever. What matters is the unemployment rate, and that's not likely to change. But what is the one thing that is different about this NFP versus other NFPs throughout the year? The one thing that's different is university students graduate in May and look for their first job in June. So that could increase the workforce pretty quickly and maybe tickle the unemployment rate. But that's all really right now. So, but we're talking about gold, but you have to then say, whoa, what would the reaction in general be to non-farm payrolls? Do you think it's going to be bad number or good or benign? Well, we are in summer now, so benign is much more likely than before. But then you also have to look at the relationship of gold to the general market. So we do something called the Pearson correlation coefficient analysis. And over the period of 90 days, we watch all our assets, but we watch for how they move in relation to each other over the last 90 days. So everything is moving and fluctuating. Just imagine all kinds of things are going up and down, up and down, up and down throughout the day. And but of course, across a period of 90 days, there's a lot of things happening because we're overseeing 72 assets moving in real time, but we are analyzing how they move together. So, for example, as one is generally going up, does one generally go down? Or do these two things also go up, but one goes up faster and the other one goes up slower? So, steeper curve versus flatter curve. So, now you got to do linear projections. And then do comparative analysis of linear projections to all 72 current 72 assets in real time. Do you understand the complexity of that? Yeah. So it's awesome math. And so what this says is, okay. And who asked wait, who asked the question? Ragul FX. So you got to look at we're going to start with the general idea of VIX, volatility. So typically what we have seen over the last 90 days is when volatility spikes, and that's usually a bad thing, because think about it this way, everybody. It's not volatility in the sense that you think of volatility. And this is really important because you're like, well, volatility could be good, it could be bad. So why do they call it a fear index? Why do they call the VIX a fear index? Because it's not volatility. You've been told the wrong things. It's not a volatility, but this is what it's called all the time. The VIX is just simply a measure of the proportion of options purchased against the S&P 500 for the purpose of hedging. So you only hedge when you think things are bad. You don't hedge when you don't believe things are bad. And you especially don't hedge if you think things are great. So falling VIX is good. Rising VIX is bad. So if NFP comes out, okay, you follow me, Ragul? If NFP comes out and the market goes, oh my God, that's horrible, and they start hedging, VIX will go up and gold will go down. So what, let's say VIX jumps 10%, gold will fall 5. Actually, 4. Okay? To be more specific, but okay. You see how this works? So I don't know the results of NFP and I don't know the response of the market, but I can read other people's choices. So the secret sauce to traders and probably trading in general is that you can see what the institutional investors are doing. How would you like to have for free an ability to have insider trading knowledge about institutional traders? It's legal and it's ethical. The data is out there. You just need to know how to read the tea leaves, which we do. So again, like, I don't know what NFP is going to be. How would I now I could guess and I could say, well, NFP could be above 100, and yet for whatever, yet unemployment could rise 0.1. I hope not. I don't think so, but it could. Great, but I still don't know. And then I don't know what other people think about that. Like, does it matter what I think? No. Does it matter what you think? Maybe, but no, not really. Okay. What we do want to know is institutional investing. And if they go, oh my God, look at NFP, hedge, everybody hedge, we will see it. And then we can go boom, 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 boom. Okay. So look, Hanrose just said, will it sell? Dude, were you listening? I just covered it. Are you? I just covered it with analytics. Okay. Cool. But here's another way. Okay. Here's another way to answer that question. Do I think gold will sell? Well, okay. Watch VIX. But what we know is gold has been trading the opposite of VIX. Okay, so VIX down, gold up. That's a risk on scenario. Are we in a risk on scenario? You need to answer that. We have all the data. I mean, it shouldn't be difficult for you, but you should know the relationships instead of, dude, like seriously, you're going to ask a YouTube guru their opinion on how to trade and invest. Like, hey, should I sell gold today? What's wrong with you? If that's what you're doing, I'm not saying that that's what you're doing, but think about the people that do this. Really? You take trading advice from a YouTube guru? What the hell's wrong with you if that's you? Like, seriously, that's such a joke. Now, are they licensed and registered? No, probably not. Have they ever traded money for professionals? No. Have they ever actually had a client? No. Do they have an education? Which Ivy League did, like, think about it. It's funny. Which Ivy League school did your YouTube guru go to? I only went to Harvard for 2 degrees and Oxford and MIT and Harvard Business School. But besides that, I'm self-taught. I think that's probably unique in the world of YouTube guru. And I'm telling you, don't listen to me. Use the data. But don't take advice from some unqualified knucklehead on YouTube. Right? So anyways, I'll tell you how to make the decision. So I'm saying watch VIX, watch the reaction to the market. And if you're watching VIX as a reaction to the market, now you can see what the institutional investors are doing. You have the correlation data, which is updated several times a day, and you know, like hardcore correlation data that only goes back 90 days. It doesn't go back 90 years and you find out, well, back in 1972, this is the relationship between VIX and gold. Well, we had gold, but we didn't have VIX. Okay. So this is very, very real-time type data to say, oh my God, look at the spikes in VIX. Institutional investors are hedging. Take gold down. And that is how I want you to trade. But if you're doing everything off your MACD only, dude, you're counting waves. All right. So anyways, I've beaten that horse to death. Hey, what's the market doing right now? Today, flat, but we got a huge improvement in risk. Welcome to July, as they say in Georgia. Okay. Yeah, so we've switched from a negative risk-off regime into, I'm not going to call it positive, but up. But remember, we've already analyzed this for the entire year. We're expecting up and then not up. So far, so good. Our data is quite complete. We're looking at VIX, U.S. oil, the put call ratio, gold, Bitcoin, the 10-year yield, junk bonds, the Dow, the 210 spread, the DAX, investment grade bonds, the US dollar, NASDAQ, the 2-year yield, the S&P 500, and Nikkei. Then we weight their importance. Then we look at the 1-day, the 7-day, and the 30-day changes in these asset prices and weight them, meaning, long-term is more important than short-term, but long-term could be too slow. So really, the weekly one is more important than the daily and the 30-day. And then we take that and make a composite score of each one of those observations and then put an overall aggregate score for the general risk scenario, but on all 3 time frames. Holy schnicker. Yeah. So what's going on in the world? Well, right now we're flat to slightly bullish. So what does that say about the need to hedge? Less need to hedge if the market is generally speaking up. Cool. So VIX should be down. Well, VIX is down. That's so smart. And one way you can look at it is like, okay, VIX is down today. This VIX is down this week. So this is where we are. Joe Face. Hey, which Joe is it? It's been a long time. Who the boss? So anyways, good to see you, Joey. Okay, so that's how we got to that. What time is it? We need to. Oh my God, we got to get going, don't we? Uh, 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 uh. All right. Oh, roll 115 maybe. Claims pretty stable. Unemployment rate stable. Look at this. Average hourly earnings actually declining over time. From Thailand. Right on, man. It's been a very long time then, hasn't it? Like a very long time. Okay. Jolt's doing all right, guys. Okay. We were down here at 6.5 for a minute and we're popping up. So far we're seeing general stability. General stability. Private, smaller business, a little slower. Okay, that's quite stable. Well, I love trading, Joey. Hey, wait, Joe, were you a firefighter in New York? I'm going to make sure I got everything squared away in my brain. Yeah, I'm trying to connect the stories, right? Dude, Thailand. You know, it's unbelievable. No, not you. Yeah, okay. It's unbelievable that that means it doesn't mean I don't know who you are. It's just I'm trying to connect the stories, right? There that we had a firefighter maybe 20 years ago, 15 years ago. Actually, it would have been longer because it was right after 9/11. Oh yeah. So oh my God. 25 years ago. Uh we had a firefighter in New York City, and after 9/11 he lost a lot of friends. He was there, he was working in the towers and everything. He lost a lot of friends, and it was really tough on him personally. And that's why he was like, I need to do something else. His life was falling apart, his marriage was falling apart, just he was emotionally distraught, just. And so he turned to Forex as sort of a means, like, how do I pick myself up and move on? And well, he ended up moving to Thailand. and trading Forex full time. And he was so happy. And he was sending me emails about like, hey, he's like, even the medical stuff here is amazing. You go to the hospital, it's fully modern. They got all the same technology as an American hospital, but it's not $5,000 for them to weigh you and measure your height. Right. Anyways, and his name might have been Joe or John. So anyways, Joe Face. Yeah. So I got to come visit you in Thailand. I've been around the world, and I've never been to Thailand. All my friends have. So we just burned through the data, and it looks quite stable, doesn't it? So is there any reason the Fed should freak out? No, not really. That's important, isn't it? Wait. The other YouTube is streaming still. This is crazy. Wow. I'm being told the other stream is still streaming. I don't know what the heck is going on. All right. Well, we got you here, right? Yeah, Joe, where are we going to go, Joe? All right. We got our news coming up. I think what we'll do is we'll watch it from here.
Feds Daily. In the U.S., there's exceedingly
From our
strong
squawk
investment
box.
growth. U.S. dollar. Near-term support with higher rate volatility. MUFG. The U.S. dollar is lower ahead of the U.S. jobs report. What are the technical levels in play? Oil prices edge down amid hopes for U.S.-Iran talks progress. Locked and loaded for non-farm payrolls. Eyes on wages. U.S. bond yields tick up on hawkish Warsh rhetoric. Payrolls awaited. Sterling today. Pound firms as dollar softens ahead of U.S. jobs data. Mexican peso. Policy uncertainty caps. Nearshoring upside.
This is free.
Societe
The
Generale.
squawk box.
Crypto today. Bitcoin, Ethereum, XRP steady rebound as U.S. and Iran conclude positive talks in Doha.
Euro, yen price forecast. Euro holds above 183.75 with bearish pressure mounting.
2 minutes, y'all. We could watch it from here, I suppose. Let me refresh the page. Hope you've had your broccoli and your carrots and your kale and your
Spike
spinach.
alert, 90 seconds until United States unemployment rate is released.
In fact, you know what? I'm going to go back. Should we do it here? Let me hang on. I want to do over here. Let's go over here.
Feds Daily. In the U.S., there's exceedingly strong investment growth. US dollar.
30
Near-term
seconds.
support with higher rate volatility. MUFG. The US dollar is lower ahead of the US jobs report. What are the technical levels in play? Oil prices edge down amid hopes for US-Iran
I
talks
didn't mean
progress.
to reload it,
Locked and loaded for non-farm payrolls.
but I want to
Eyes
hear
on
all
wages.
the
U.S. bond
subcomponents
yields tick up on
of the
hawkish war rhetoric.
situation report
Payrolls awaited.
after it
Sterling
comes out.
today. Pound firms as dollar softens ahead of U.S.
We
jobs
need
data.
to know more than
Mexican
just the
peso.
headline number.
Policy uncertainty caps
almost
nearshoring
meaningless.
upside. Societe Generale. Crypto today. Bitcoin, Ethereum, XRP steady rebound as U.S. and Iran conclude positive talks in Doha.
Euro, yen price forecast. Euro holds above 100.
Oh, it went down.
United States unemployment rate actual 4.2 beat forecast.
Is it right? No.
Euro labor resilience and ECB split shape outlook, BNY.
Really? Wow, let me pull up the report. Bureau of Labor Statistics. So we got a plus 57 is down less than expected, y'all, but a 4.
United States U6 underemployment rate declined to 7.9% in June from previous 8.1%. United States unemployment rate registered at 4.2% below expectations, 4.3% in
That's
June.
huge.
Wall Street aims to open broadly higher.
Cool. See, what I care about is the unemployment rate. This is why it pops up. I don't care about NFP because A, it's volatile, and B, you can have 50% revisions. So they're like, next month, they're like, you know what? We're wrong. It wasn't 57. It was 107. So like, how is that even reliable? Right. So this is why I use the unemployment rate. I thought maybe we could tick up to 4.4, but realistically, we'd stay at 4.3. But 4.2 was not on my radar. Oh.
Breaking U.S. non-farm payrolls rise by 57K in June versus 110K expected.
United States continuing jobless claims came in at 1.8 on 14M, above forecasts 1.81 mem in June 19th.
Dude, this is such a good squawk box, isn't it?
U.S. initial jobless claims 215K versus 220K estimate.
I used to pay $399 a month for a squawk box. Now I give it to you for free. You're welcome. Look, everything we've seen here today is free. Are you in? Are you going to use traders or what? Let's go. Let's check the market's reaction because a lot of you are like, what about gold? What do I do? Really? Okay, really? You don't know what to do? I just cured your problem. I just fixed your trading cancer. Okay? This is curable. Yen is strong. CAD is weak. Here's everything in between. Why do we know yen is strong? Because we look at USD yen, Euro yen, pound yen, CAD yen, Kiwi yen, Aussie yen, Swiss franc yen, and we do our calculations and create a synthetic indice for every currency on the planet. Each one of these takes 15 calculations every 3 minutes. This is the source of truth. This is only price. This has nothing to do with fundamentals. This is happening right now. Big Perm says, should have placed the trades earlier today. Yeah, for sure. Yeah, thank you, Biggie. That makes sense. Crypto, you should already know this is on fire. How do you know? You just log in and look. We watch 72 assets in real time, multiple time frames, millions of data points. So you're like, what should gold do? Okay. Now we were talking about VIX, right? So are you watching VIX? Macro Sven says, right? It'll be a fade. Yeah, but maybe not necessarily today. How about that, Shran? We can do the seasonal stuff later, but yeah, but not necessarily now, right? So the thing is, are you watching the changes? Is yen getting stronger or less strong? Well, Greg, when institutional investors are not investing and it's retail traders betting and they're getting their stop losses blown out 3 minutes after non-farm payrolls is released, it doesn't even matter. Yeah, it just doesn't even matter, does it? You just like, whatever. So we know you should be focusing on yen and CAD right now. And pound CAD looks good. Pound yen, be careful. Be careful because we probably maybe want to buy a dip off the moving averages. See, look, we're very bullish, and very bullish, and we even have a projection bullish, and the moving averages are bullish. The oscillators are bullish. This is a pretty good trade. Now, on pound yen, okay, we know yen is strong right now, so it is pointing down. That makes sense. But we're bearish, neutral, bullish. So maybe a pass on that one. It looks down in the moment, but probably up tomorrow, right? Bearish, neutral, bearish, Swiss franc and yen, and pointed down, but it doesn't look dramatic, does it? No. Kiwi CAD, bullish, neutral, bullish. Now, the reason I'm reading bullish, neutral, bullish, and all these other things, let me just kind of square you away. What we looked at before, when you saw the bars changing, okay, that was pure price analytics. It only looked at price and change of price. That's it. And relative price changes to another asset. Okay. What we're looking at here is fundamentals and technicals combined. Okay. So Kiwi CAD up. And the chart is up. Although the moving averages are down, the projection is up. So the trend is neutral. The chart is bullish. And the fundamentals are bullish. Now, in the near future, if this continues, which means this will need to make a higher high, the 21 will cross above the 55 and it'll go bullish, bullish, bullish. So now you have to decide, what do you want to do? I want to rock. Okay. And so we can put all that in together. And right off the bat, I don't see anything that amazing. How's crypto doing? Okay. Change of fate. Slide a hand and change of fate. On a bed of nails, she makes me wait. But what do these charts say? So high. How's our stock indices? Hey, if you're part of my council of investment advisors, we need to meet on Monday and we need to discuss summer rotation. Okay. Macro says, why would the 30 and 20 and 10 drop on this news? Are you talking yield or price? Okay. If you're talking, why would the 30 and 20-year drop? That means there's a rally in the treasury market, and they're telling you that they've locked in the highest return on investment likely over the medium to long term, aka the Fed is not going to raise. But see, that's the thing, Macro Sven. What do you mean even with stronger job market? The Fed wants a strong job market. They want a strong job market. It's their mandate. So that's where, like, I question people that say, and like that FX Street article, oh, the job market's great. The Fed needs to kill it. No, that's not how it works. You would look at wage growth. So if you want to go there, let's go there. Dude, you want to battle? Hey, Sven, you better bring it. Oh, I'll bring it. Yeah. So let's roll up our sleeves here. Let's do the work. So the Fed would raise interest rates not to kill the job market, but to kill wage growth. All right, so let's look at it. This is the employment situation report in the United States, otherwise known as non-farm payrolls. Okay, total 57,000, unemployment rate 4.2. Okay. We're looking for growth, wage growth. So household survey, you're not going to get wage growth. So they knock on the doors of people and say, hey, how many people live in this house and do they have jobs? They don't care if you have 5 jobs or no jobs. It's just yes or no. And they gather that, blah, 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 blah. And it's a big, giant guess. But they tell you that data. Then they do the establishment survey, the business survey. Instead of knocking on household doors, they go knock on the doors of businesses. And they're like, let us look at your payroll stubs. So they could count a worker that works all day, with their PhD as a scientist, and then at night work at the Starbucks to make enough money to pay their rent. That would get counted twice because there's 2 pay stubs. If it was a household survey, they say, hey, do you have a job? Yeah. They wouldn't say things like, oh, you have a PhD and you work at Starbucks? Maybe you're underemployed. That's a different thing, right? So anyway, so now we're looking at pay stubs, and then they're like, well, how much are you paying these mofos? See, a socialist thinks a capitalist hates their workers and is trying to grind them into the ground. A true capitalist wants to treat their workers as best as possible because it makes them more competitive. A happy worker is a productive worker, is a profitable worker. Socialists are knuckleheads. Yeah. But anyways, in June, average hourly earnings for all employees and private non-farm payrolls rolled by 13 cents or 0.3. So year over year, 3.5%. Okay. That's about what it's been for a while. It is high, but it's where it's been. So, so it's not even going to say, but here's the thing. That would have to spike. I mean, spike. What's the, does anybody know the Fed funds rate in the United States of America? 3.75. Oh, 3.75. And wages, wage growth is high, but less than the Fed funds rate. Does the Fed need to immediately freak out and jack up interest rates so people lose their jobs? Therefore, wages would fall. No. So that's the narrative, like that. This is why you don't pay attention to the media, because they just don't get it. Oh my God, look at the non-farm payrolls. Unemployment's fallen, so the Fed's got to jack up interest rates to kill it. Like, why? That's not even the point. And so then you look at the point, and the point is this, and you're like, that's higher than usual, but not since COVID. That's actually down from COVID. So the relative trend is one of two things: not a big deal, or actually an improvement. But freak out point for the Fed to raise interest rates? No, that would not be correct. So if you were my undergrad student at my Harvard economics class, I would mark you wrong. No, that is not correct. Because if this is not spiking, like now, look, everything is relative. If you showed me over the last 2 years that this used to be 2, and then 2.5, and then 3, and now it's on the way 3.5 on the way to 4. Yeah, okay, the Fed might want to adjust monetary policy or some other thing to cool off wage inflation. But what if 2 years ago this was 5? Then your argument is fallacious. No, by the way, Macro, I'm not beating you down. I'm beating like the FX Street author that is just misreporting things because they don't understand. And this is a danger, because someone that's willing to give up trading for a $22,000 a year job shouldn't be giving you advice. If they understood, they'd be a trader making more than what a reporter makes. You know, you're like, whoa. So I look at them and I'm just like, dude, I totally 100% disagree. I think they're totally, absolutely wrong, but I don't know. I'm not so arrogant to think I have to be right, but why does the Fed raise interest rates? To slow inflation. So we looked at wage inflation and it doesn't seem to be out of control. So why would they raise interest rates? But we can analyze this ourselves if you want. Okay, I don't think this is updated so quickly that we have post NFP data, but it would have been updated once or twice or more in the last 24 hours, so it's recent. Okay. Come on, dude. Mm-mm-mm. Wow, I haven't had this lag like this. Hang on, let's try again. There we go. Okay. You ready? You guys want the truth? How many people here want the truth? How many people here want to know the inside information of what institutional investors that manage billions of dollars, that have hundreds of employees, even thousands of employees, they have quants, they have economists, they have trading desks, they have billions of dollars on the line? Who wants to know the source of truth? maybe there's a one hike. But also, okay, nothing more than that. There's maybe a hike. Maybe. Okay. There's just a big, fat, giant maybe. And the most likely scenario is hold. Okay. There's maybe a hike. Maybe. Then this is what institutional investors are thinking. Part of what's going on, and by the way, what's most important is watching it change, because this is just now over the course of the year, right? Like, look, oil is at 67. So when CPI drops precipitously, their opinions here are likely to change. Not everybody agrees. This is the aggregate of trillions of dollars. Okay, great. But what we want to also observe is their change in opinions, because that shows a change in the flow of capital. So this is what they think now. But in 3 months, this could be radically different. And being able to see it allows you to see the money, like Neo sees the Matrix. You can read the financial market like that. The truth, the red pill, not the blue pill. Cool. So we're tracking this, and up until let's say based on the close of yesterday, I think this updates faster than that. But what we can see here is maybe a hike, maybe, and not for a long time, maybe December. But what's important, I'll say it one more time because it is important. If you're watching the December January period, okay, watch to see if the probabilities go up or down. Check this out. 31% chance of a hike, not a guess, by the way, based on the way that hundreds of billions of dollars is being invested by very, very, very smart money. There's a 70% chance they don't hike. Then you go to January, there's a 93% chance they don't hike. Like, this doesn't get interesting for a year. So maybe December, but it could be the end of next year, 2027. And of course, by then, like, dude, that's so far out that they're pricing in probabilities based on all known information today out a year or so, a year and a half, because they have that risk profile, and they're like, well, we don't know what the world's going to be like then, but we have to make the decision now. So they make the decision. But imagine in 3 months of CPI dropped, or even 6 months from now, CPI drops significantly. Like CPI is 2.5. This maybe one hike will evaporate to like no chance in hell of a hike. We have the data. You know what? The FX Street reporter isn't this smart. You now know this information. You're like, whoa, let's discuss. Let's discuss, reporter. So you think they're going to hike soon? When? How do you know? Oh, well, I heard somebody else say it on Bloomberg. Whatever, bro. When? What's the probability? Dude, we're calculating the probabilities based on mathematics, not guesswork and not hearsay. So this is cool. So we can tell you probability, and we can tell you magnitude. But even smarter than that, we know it's not that we care about a hike in December. We care about the probabilities changing of a hike in December. And if this 31 drops to 21, game on, mofo, game on. And you watch VIX. VIX will adjust. Yeah, VIX will adjust, bro. Cool. But that's just the Fed. Did you know we have all of this for every central bank in the world? Wait, you don't read the RBA like that? Well, what's wrong with you, bro? Huh? Must be terrifying not to know. Right? Right, Biggie? You can't handle the truth. Yeah. Oh my God, this is so good, right? Yeah. Now, if you want to get a better look at the US curve, okay, this is our yield curve. Okay. It's similar but different from what we just looked at. And we are looking at the flow of capital. Money is coming out of the short term and going into the long term. What does that mean? What does it mean? Does anybody know what it means? This is actually money leaving the 6 month and the 1 year and going to the 20 and 30. This goes back to Macro Sven's question. Oh, we can look at China, although I get that data quarterly when it comes to central bank gold trading. What does this mean? They're selling the 6 month and buying the 30 year, which means they're telling you long-term interest rates are not likely to go up. And shorter term interest rates are likely to go down or less likely to go up. They're taking out a rate hike. So while certain people are writing articles about the Fed is expected to raise interest rates, these people here, the institutional investors, disagree with the FX Street article. They're like, no, that's not right. So when you analyze the actual yield curve of the United States, the Fed is on hold. None of this says they're going to raise interest rates. Isn't that amazing? So who do you want to listen to? An FX Street, writer writing articles for $1,800 a month, or hundreds of billions of dollars being put down? Well, Macro Sven, that's what this data says. So like when the article comes out day after day after day after day after day, you're like, holy crap, what the hell, bro? There's no evidence for that. That's all opinion. And by someone that's probably not educated or experienced enough to even have an opinion. Hey, truth is brutal. I know. But look, we're on the same team. So you're like, Wayne, all this is good. Just shut your mouth and show us. No. Okay, I will show you COT. Comes out. I'm not sure about the holiday. But this is another way for you to see institutional investor trades. I'm assuming you want to see the inside information, right? Let me pick something. What is the best currency in the world? Insider information. And it is insider information. The institutional investors are required by the government to report their positions. After traders have no idea, institutional investors can watch this. Check this out. You ready? Mexican peso. Institutional investors in the United States. Wait, did we just lose charts or something? Oh my God, this. Relative money, which is two different parts of the CTC report. You have to look at asset managers and hedge fund managers, right? And YouTube keeps telling me that you're losing charts. Interesting. I don't know what's going on today. I don't even know if you can hear me. Hopefully you can hear me. But I'll continue. Well, okay, hopefully you guys hear me. Okay. Look, I'm just move over, guys. Get off of YouTube. Can't help it. YouTube is struggling. And it inherently lag. Starts out as a 10-second lag, and then since I do long form webinars, end up being 4 or 5 minute, 10-minute lags by the end. I don't know why it's bugging out like this, but you can come over. So I need to find. Well, I can also check I can change internet connections, but sometimes that kills. I changed to my other internet connection. Hopefully I didn't kill the stream. Sometimes it does. But let's go back. And if there's a problem, we'll just call it a day. But look, inside information about how institutional investors are trading, where they're putting their money, and how they are changing positions. This is critically important. And right now, we can see for a fact Wall Street is heavily long the Mexican peso. Are you trading it? All right. So in the Wall Street vault, they have a lot of Mexican peso in their vault. The second thing we know, last week they added more. They bought more. So once again, does anybody here like the fact that we can have insider information and see where the money is flowing, see the trades of professional investors? Or would you rather just trade blind every day? That sounds terrifying to me. Okay. Yeah, this comes out later today, so this is going to update. Canadian dollar is terrible. The Canadian dollar is terrible. They're selling it hard on the long run, and they sold more last week. The market is dumping the Canadian dollar. The market is dumping the New Zealand dollar. And you don't know? You should be ashamed of yourself. How dare you be a Forex trader and you don't know this? Cool. Okay, now let's look at charts. We'll go back here. Yen got a little stronger and dollar got weaker. That's good. Market happy. Not happy with yen, but dollar weak is great. It'll push up crypto more. That'll push up your metals. So what do we know? I asked you to watch the VIX. And we did our period. Days, gold goes up. This is the truth. This before the news. We did it logically. We did it intelligently. We did it data-based. Quantitative analytics. And with the sum of our research, gold will go up. VIX has fallen, gold has gone up. What do I think? What I think doesn't matter. What institutional investors think matters. So we had a good non-farm payrolls. FX Street said, see, means the Fed jack up interest rate. Well, if Fed's jack up interest rates, the stock market would fall, the VIX would rise. FX Street 0, radars 1. You don't need media anymore. And by the way, I'm picking on FX Street today, but that has been writing for a long time, and it's becoming negative. On the flip side, I also watch CNBC and Bloomberg, with billion-dollar fund managers, and they're very often wrong too. You need to rely on yourself. You need to realize that you're the hero, that you're the expert, that your family, your friends, your neighbors, your community need you. Need you to help them. This is like a moral duty. You must gain this knowledge, take care of your short-term finances, meaning make money as a trader. And after that, you need to take care of the people around you. Yeah. Okay. You have a moral imperative. If you have all this data and knowledge at your fingertips and you don't use it for good, I don't know what your point is. Why do you then? Let's take a broader look at some of these things. So yen is strong. What else should we look at? That you go into the index stuff. Yeah, Abdul, but yes and no. This idea that even even AI is better. AI is very dangerous. So please take this word of advice from me, please. And this is not self-serving advice. I'm just giving you the truth through my experience. And I've been working with AI before you even heard of it. Well, that's probably not true, but 5 years. I So anyways, let's go back. Let's just do this logically. Why should you never use ChatGPT or Gemini for trading and investing advice, or any of the other publicly available large language models? Because they're very tempting, and you have to understand, AI lies. It has no problem lying because it doesn't know the truth. It just doesn't. So it'll lie. And sometimes even when it knows it's lying, it'll just make stuff up. Okay. But that's not the point. The way that your ChatGPT and your Gemini and your Perplexity and all these other large language models, they have all been trained on the internet. So it doesn't know the difference between you asking, you know, how to build a trade plan versus how to create a cooking recipe for garbanzo beans and sardines. It's just, what does the internet say? That's all you're asking this AI stuff. What does the internet say about trading Forex? Cool. So let's now analyze that. So ChatGPT and all the others, they go out to the internet and they look at millions and millions and millions of data points on the internet about how to trade Forex. Okay. Point number one, 95% of traders lose their money trading Forex. So that data, by and large, is garbage. Number two, point number two. How many institutional investors do you believe are making billions of dollars trading Forex and have decided to publish their strategy and their logic and their intelligence to the internet so that AI could read it or other people can copy their strategy? What percentage do you believe? Okay. You take these two things and say, all right, if I ask ChatGPT, it'll give feedback based on garbage. Garbage in, garbage out, right? And then it'll give you a beautifully written and very convincing response. And this is the problem with AI. People that don't understand it will just follow it. The sheep jumping off the cliff. Be careful. So we do has not, there is no ChatGPT at traders. There's no Perplexity at traders. There's no Gemini at traders. We have no public large language model connect at all. In fact, we don't have an internet connection. The only thing that traders is connected to is central banks and government agencies. And our analytics is all done originally by an LLM I created. And then we added machine learning. Then we added relational mathematics. And then we did relational intake. And traders is a neural network. So do not use ChatGPT. You could use automation to do things, but don't let it do analysis for you. Because, you know, what it's going to do is read 45,000 articles written this morning about how the Fed has to raise interest rates, yet you not spend seconds. You can go through the actual data and say, well, that's not actually what's happening. That's actually wrong. So do you want 45,000 opinions, or do you just want to see the matrix? And you're like, wow, I just see the truth. Okay. Okay. Cool. So pound CAD is actually doing pretty killer, and pound Kiwi. So these are quite good. CAD yen. Okay. Like if we go to CAD yen, I'll go to table view. Oh, it's on the bear side, right? CAD yen. Flat for a while because we've been waiting for NFP, and off we go. HOTT. And we're comparing the fundamentals. We're comparing things like the charts and seasonality, institutional positioning. Seasonality. July is a down month for CAD yen, and even worse in August. So how do we read this? You're a seller of CAD yen in July, and you keep yen strong right now. Weak, so it is working. Here's the chart. Here's the positioning, right? You see this? Market is 50-50, but they're going to get short. Most likely is the historic norm. So this data right here, seasonality, is 20 years of weekly data. Yeah, 52 weeks over 20 years. You know what? I keep looking over and it looks like YouTube is just terrible, right? Should I keep going? I don't know. I even switched internet connections. It should be perfectly run. I don't, this is one of the strange. I've been doing YouTube for 20 years, right? 18 years, as long as YouTube's been around. This is the strangest day I've ever seen right from the get go. I don't know what's going on, but it looks like I'm coming and going on YouTube. Are we good? Are we okay? Should I keep going? Well, let me turn the cam off and see if that helps. Okay. We'll look at cat. And see if it's smoother. Maybe that'll help. And I'll stay quiet. I'll turn my mic off. I was singing. If you won't hear me sing, just let me know. Well, you should have video. I'm being told you have video. I'm just trying to turn off other things that would slow the webinar down, slow YouTube down. Yeah, let's forget it. I don't know what. So, anyways, let's go. Let's just cut it. You got But remember, you can log into TradeRs and have all of this. It's not us streaming. It's not us being slow. So you can log into TradeRs, have the sit rep report. You can use the squawk box, and you can use the real time charting, the real time synthetic indices. It's all there. Like, just log in and use it. Screw YouTube. It's right there. Just log in and use it. Almost everything's free. You don't have to spend $2 million building this. Yeah. You don't have to spend $30,000 a month on data. And more expensively is the compute. The compute we're doing is nuts. And I'm making it free. Like, you just get in and use it. It's free. You know what it's required to register? An email address. That's it. And no sales pitch, no sales funnel. If you don't want this, don't use it. If you want to use the free stuff, use the free stuff. If you want to upgrade to the premium stuff, dude, well, then do it. But I don't need to convince you. So whatever, just, it's there. So peace on earth, may the pips be with you, may your profits be above average. I'll see you Monday. Tomorrow, hey, if you're not American, tomorrow's a holiday. The markets are closed. There's no trade. And America, happy 250 America.